Good morning, everyone. Welcome to what I think is close to our 10th webinar, the Laurium Capital webinar Boardroom Talks. Today, we're going to be focusing on one of our newer products, the Laurium Africa Bond portfolio. And with me today, I have Paul Robinson, who's the portfolio manager of our Africa Bond Fund.
Hi, morning, everyone.
And it's great that all of you can join us today. We've got a few slides and then we'll move on to questions towards the end, but please feel free during the presentation to pop any questions you may have into the Q&A question box. We'll try and be succinct and stick to sort of 30-odd minutes to go through the slides and then open for questions thereafter. But thank you again for joining us today. So I hope you can all see our screen. Just to kick off, we thought we'd touch on the motivation for launching the fund, which is close to a year and a half old now. Back in the end of 2019, we saw a glaring gap for US dollar yields internationally that one would perhaps potentially want to access through Africa. We've got experience and a lot of skills in Africa. We've been dealing in the space for 12 years. We've been running an equity fund, which has the ability to also invest in the fixed income markets, and we have done so on an opportunistic basis. Paul has been involved in running that portfolio for a number of years with Gavin Forberg, and that portfolio has done particularly well. We are very aware of the fact that the perceived risk of Africa is a lot higher than one should actually be paid, and therefore there's a great risk premium that one can glean from investing in the space. The other thing which is of particular relevance is within South Africa, we are limited by the SARB to 30% allowance offshore within our Reg 28 mandates. But in addition to that is an additional 10% that one could invest if one had access to African markets that one was comfortable with. So we saw a gap in that space. Equities in Africa are less liquid and less accessible, and even our own fund we aren't able to invest in with our multi-asset portfolios, and we saw the opportunity then to potentially invest via this particular product. And through our research and setting up the product, we established that there's fantastic diversification benefits from investing in this particular asset class, and that there are very low correlations between the Africa Eurobond space and South African investments. So just to highlight the vehicle itself, we launched a RAND unit trust back in December of 2019. So it's rands in, rands out, but you are investing in US dollar instruments as the underlying. So you are not ZAR hedged. So the volatility of the currency does play a factor in terms of how your performance comes through in terms of your RAND performance. And just to highlight it, if the RAND's appreciating like it has done for the last few months, that does reduce or deflate the fund's returns. But alternatively, when the RAND blows out, when there are times of crisis, as we saw in March last year, it's a great way of protecting your investment from a RAND perspective. And just to highlight, currently we are using the unit trust, but we will be launching a dollar version of the fund in the coming months. And then this fund will convert to a feeder fund. So you will have both access opportunities, whether you wanted to come in with US dollars directly from offshore, or if you wanted to use your RAND investments via a unit trust or a Reg 28 portfolio. I'll pass over to Paul to cover some more details about Eurobonds.
Great, thanks, Mike. I see we've got quite a broad array of participants today. Some people, I think, have heard the story and know what we're talking about. Others are fairly new. So we're going to pitch it fairly kind of basically, but delve into more detail. But if you do have any follow-up questions, please obviously just get hold of us at any stage. Firstly, what is a Eurobond? This is actually quite an important question. The Eurobond basically is a hard currency bond issued by either country or company. It's not got anything to do with actual euros. There are some very few euro bonds, but it's predominantly dollar bonds. So it's hard currency bonds issued by either a country or company, usually trades outside that company or country, or that company's domicile. So all the Eurobonds, generally, they settle in Europe on the European settlement systems, Euroclear, Clearstream, etc. Your money doesn't go into any of the African countries involved. It stays totally offshore. For example, Ghana, South Africa, Egypt, whoever, all have issued dollar bonds that trade offshore outside those countries. Those are called Eurobonds, fairly simple. Africa is still fairly new to the Eurobond space. You can see a little stat there. It's just a tiny sliver of the global Eurobond issuance, but it's becoming quite a nice tradable market over the last decade or so, and it is quite an interesting space at the moment. Yeah, I guess just distilling it down very simply, we'll show you a few graphs in a while, but I think you're getting a very good US dollar return, a US dollar yield from these African sovereign Eurobonds, relatively low vol compared to, if you look at South Africa in dollars, or if you compare to equities, African equities, you're getting relatively low vol. And it's pretty liquid. And as Mike has said, South Africans, this fund, our fund is obviously classified as Africa for Reg 28 purposes. We have been looking at Africa since 2009, investing both fixed income and equities. And lastly, I think just a key point at the bottom there highlighted in red, we very much eat our own cooking. We have a lot of faith in this fund, and it makes up a key part of our multi-strat funds, over 3% of our balanced fund and 2.5% each of our flex and stable funds. Just going back a bit historically, looking at how this asset class has done, using the Standard Bank Africa ex South Africa Eurobond Index, which is a pretty good proxy for the investable universe. It's got some issues, but it's not a bad proxy. You can see almost 9% CAGR in dollars over the past 13 or so years, outperforming quite nicely both JP Morgan MB and global high yield. If we look at it something closer to home, compare it in the red at the top there is obviously the African sovereign Eurobonds. Also, again, very strong outperformance versus the Aussie.
Cap Swiss.
Yeah, sorry, Cap Swiss, MB, things like that. Rates, where they're going from here, we don't know for sure, but it does seem to us we are still in a low rate environment for longer. We will touch on the recent rates increase, small increase in the US of the US Treasuries and US bonds, but we believe we're still lower for longer in terms of rates, in which case this fund has got 5-10 years of good returns, hopefully to come. So this chart, I think this chart, along with the next chart, are the two most important charts for me of this. If you remember, just to remember these ones, please. Basically, this is the spread over US Treasuries of African sovereign dollar bonds in red. The black is high yield, so junk bonds, effectively. And the pale blues is the JP Morgan MB, the Emerging Market Bond Index. And those are the spreads over US Treasuries. We believe that these African sovereigns should trade tighter or at least equal to junk bonds, to global high yield. We don't think they are any riskier at all. And we think there's just so much more that a country, a sovereign can do, so many levers they can pull, so much in their toolbox, medicine chest, whatever you want to call it. And there's so many more organizations and people out there who are going to come to the aid of a country over and above just some random high-yielding corporate out there that's really just been lifted along with everything in the global hunt for yield and global stimulus. So you're getting paid basically 5.8% right now, spread over US Treasuries to hold African sovereign bonds, versus only 3.8% spread. So that's at 376 basis points there for global high yield and 350 basis points for MB. We think this is a bit of a mispricing. We would expect that gap to narrow over time. And again, we think it's just the perceived risk of these Africa bonds is just so much higher than actual risk. And we've seen it firsthand now in this time of crisis. It's been actually a great time to see exactly what happens during the tough times. By April last year, so literally a month, 2 months into the crisis, the IMF had already dispersed close to $14 billion of effectively loans, no strings attached, very low interest rates, either 0 to 1.5%, either 5 or 10-year bonds, to countries to help them out. And that's really just that level of support is not seen if you're looking at high-yielding corporates, that high-yield index bonds. Looking at the absolute yield at the moment, so our fund is 6.8, just under 7% yield to maturity, running yield very similar to that, versus South Africa government bond, which is only 4.5% in dollars. Emerging markets as a whole are getting roughly the same, and the high yield index is fairly similar to that. It's going to be a bit higher than that now. So again, you're getting a great yield pickup there in an asset class that, again, we think the perceived riskiness is a lot lower than the actual risk. And now's a good time, I think, to have a look at some of those risks and try to address some of those fears.
Thanks, Paul. So we thought we'd sort of address the elephant in the room. What are the fears around Africa, and why haven't people been using it within portfolios? Is it a space that you haven't really looked at properly? Is it something which one of these particular fears, or perhaps more than one of these fears, is keeping you out of the market? So what we've done is just sort of highlighted items that we've discussed in various conversations around this product over the last year and a bit, and thought that we'd summarize responses to them to hopefully alleviate your fears around them. So I've addressed what we think they are. Volatility, is that one? Liquidity, is it local currencies? The fact that you're concerned around those, is it the local infrastructure of the markets in Africa? Is it that you're worried about being in something which will perhaps passively track a market that is potentially very inefficient? Is it the lack of choice? Are you sort of looking at a pile of potatoes within a very generic market, or is there actually differentiation throughout the African continent? And then really essentially, how much yield is enough? How much should you be paid to be in a space like this? So I'm actually just going to pop up a poll which should launch now, where you can respond to those and just sort of make your choice. I'll only let you pick one of those for now, and hopefully at the end we can see whether we've addressed it or not. Right. So in terms of liquidity and size, what is the size of this particular market? Well, it's grown substantially over the last few years. As you can see in the chart coming in on the right here, we started off in 2006, very nascent market, and that has grown in almost a compound fashion since then till this last year, where it grew sort of 20-odd% from 120 to 156 billion in dollars in size. And in addition to that, it's actually incredibly liquid. So if you compare it to our Aussie, it's trading $500 million a day. So for a fund like ours of 30 million, it's only about 6% of the daily trade. So it's certainly not a concern for us from a liquidity perspective. And in terms of running the portfolio, we haven't run up against any concerns of getting in and out of positions to date. In terms of the local currency concern, you are not actually engaging in local currencies. You are investing in a hard currency, which is settled in Europe, the Euroclear market, amongst others. And that's either in dollars or in euros. It's a regulated, transparent, and efficient market that you're interacting with very low transaction costs. So you're not coming up against those high costs that come with investing in inefficient markets and local exchanges. Your money is not actually going into Africa. It goes essentially into Europe. And in addition to this, in terms of setting up the portfolio and the product, we haven't had to set up any markets. Everything is done through these exchanges or settling in the European markets. Yes, we feel there are attractive yields in this space. So there's a little highlighted section of this graph. It's illustrating the interest rates around the world. And we think that the African region is offering particularly good yields that we are able to tap into through this fund. Paul can take you through a few of the details around this.
Yeah, so a key question, I guess, is how much should you be paid to be buying the bonds of African countries? So we've done quite a lot of work with default rates in a whole of Frontier and EM going back 40 years using Moody's data, a Moody's report out. And effectively, what you can do is you take your expected default rate of the ratings band where these bonds sit, and you multiply that by your recovery rate. So basically, you're getting, if there's a default event of these bonds, you don't get no money back. If you put in $100, you don't get naught back. Generally, you tend to get back roughly in the region of 65, 70 cents on the dollar, something like that, in event of some kind of default. So going back again, looking at 40 years history, if you take that probability of default of this ratings category times your recovery rates, effectively you can back out a required risk premium, what you should be paid to be taking on this level of risk. And that risk premium calculates it to 2%. So right now, theoretically, there should be roughly, you should be paying 2% more than, well, earning 2% more than you do on US Treasuries to take on this risk. However, you're actually getting paid 5.8% more right now. So I think that's a key for us. The pricing as well as the yield are just so attractive right now. You're getting a really good, let's say, not just yield, but the actual pricing that you're paying. We believe that you're getting paid a lot more than you should theoretically for the risk you're taking. And again, it's a lot to do with why we're so comfortable with this. Is there's just so much more out there in that medicine chest, so many more people who will come to the aid of a sovereign, and so much more that a country can do. I mean, if you look internally, what a country can do, they can usually, in most cases, vastly improve their tax take, increase their tax nets. They can do all sorts of things with monetary policy, etc. And that's not even considering the likes of the IMF, who will come in and structure some kind of program for them.
Thanks, Paul.
Yes, Mike said, sorry, I'm flicking around a little bit here, but it's a fairly new asset class. So traditionally, a decade ago, an African country would go to the Paris Club or the IMF or the World Bank or the Chinese or the UK or someone like that and try to borrow directly, bilateral and multilateral debt. But then starting probably a decade ago, there was just more and more issuance of these Eurobonds. It's a quick, easy, clean way to borrow money. It's very transparent. Everybody can see what the rates are, what the terms are. So countries are more and more starting to enjoy borrowing via this Eurobond market, and it's good for the countries as well. We believe, because it's very transparent. It's not like someone like Zambia who's looking a bit dodgy at the moment, and a key reason of that is that they've borrowed a lot from the Chinese, but nobody knows the terms. No one knows how much it is. No one knows anything about it. So that's really not great. There are 20 countries right now that have issued Eurobonds, over 80 different sovereign instruments. There's a lot more countries that you can invest in the fixed income side than you can for equities, for example. There's about 16 investable equity markets. There's over 20 markets where you can invest in fixed income. And you're getting quite a in terms of portfolio management, you're getting a proper full curve now. So you can see kind of that chart does out to some of the major bonds in the universe, in the Africa sovereign universe there. You can go all the way from kind of a couple of months out all the way to 40 years out. Choose where you want to be on the curve. You can manage risk that way, pull back duration, etc. So yeah, properly investable space right now, where it hasn't been it wasn't a decade ago. A key concern and a key issue is what happens when rates rise in the US, especially what happens when they rise quickly. What we've actually seen historically is that what happens is that the spread narrows during that time. So basically what that means is the yields that you're receiving from these Africa bonds will remain roughly flattish, even when those rates rise, and it just is the spread comes in effectively. So you don't lose too much money there. Don't forget, you're also getting a good yield. You're getting 6.8, nearly 7% yield. So there's quite a lot of buffer. There's quite a lot of capital you can lose. The rates can move quite a bit for those Africa bonds until you actually start losing money, because you're getting your 7% yield a year. That really does buffer your losses to a large extent. And also a key part of this is why rates are rising in the US. So basically they're rising because there's growth coming back. There's a bit of inflation coming back into the US, into the system, to the world. But that's a good thing. It's caused by growth coming back, the realization that actually things are normalizing, the vaccines are starting to work, things like that. So it's a risk-on environment. Same way we see the rand strengthening right now. You see these rates staying fairly level for these Africa bonds, even though rates are rising in the US. It's kind of a good news rise, let's put it that way. And we've seen that play out now recently in the last 2 months. Rates have increased. The 10-year has gone from about 80, 90 bips to, 1.3 or something like that in the States. And that spread has narrowed, which means that the African sovereign Eurobonds the yields are flat or have actually come down. So you've actually done quite well there.
Thanks, Paul. Mike. So the other concern is volatility, and as an investor, you're either looking at this as a US dollar investment or as a rand investment, depending on where you're using it. We did a little poll as part of the registration process to try and establish where people are taking money from in order to invest in this. It looked like a fairly even spread across the answers, so it does seem like quite a diverse approach to using this product. In terms of your experience as a rand investor in the space, you have generated a substantial outperformance of our markets, of our ALBI in both equities and bonds, and have outperformed ME and the high yield at a similar level of volatility to the ALSI. Now that is both your upside and your downside volatility, so perhaps your downside is a little bit less, considering that you've outperformed so much. And maybe just to highlight the impact of the rand moving in your favor in times of crisis or in times of down months is, as you can see on the right side in the table, I've highlighted that the negative months over this full period of about 13 and a half years or 13 years has been that you have had less negative months in this particular asset class than you have in the ALSI, the MB, or in the African equity space by comparison. So this is what your investment experience would have looked like in dollars if you had invested in our fund since inception. So the pullback back in March last year looks substantial, but that pullback was actually 12% less than the universe, thanks to the active management of the portfolio by Paul and the team. And then the recovery is substantial from there. So you've almost had a 30% dollar recovery from the end of March in dollars. But in rand terms, your experience was substantially different because of the currency impact. You can see the pullback back in March doesn't even look that dissimilar from the experience in December. You pulled back 3.3% in that particular month in rands because the rand weakened so substantially through the crisis. You then have recovered quite well through to the midway last year. And then although the product has done particularly well in dollar terms, you have had the deflation effect of the rand if you are looking at the fund in rand terms as a unit trust holder. Comparing the rand performance against our markets over that same period, you can see your ALBI experience, the pullback in March last year, and then the recovery brings you to sort of roughly 3% less than where you would have been in this particular portfolio. And then the more volatile cat Swix experience of being in our equity markets, you still have quite a bit of headway ahead of that, even though the recovery does feel quite significant, certainly over the last 3-4 months. From a correlation perspective and diversification, what we've highlighted here is the last 10 years, interactions between this particular asset class and other asset classes that you may use within a multi-asset portfolio. So equities, bonds, cash, your offshore equities, your offshore bonds and offshore cash. And as you can see, very low correlation. So a high correlation between, say, 2 passive equity trackers would be close to 1. As you can see here, these Africa bonds are not moving in lockstep with the likes of your equity markets, bonds, cash, or property, and are therefore diversifying your portfolio very well throughout the lifespan of its performance. Paul's going to talk here a little bit about the benchmark. And
yeah, so we'll touch on it a little bit in a minute or two when we show you the portfolio. But I guess the key here is active management we believe is very important. The upside is fairly capped on the returns. I mean, 7% yield to maturity on a bond, that's all you're going to get, no matter how kind of good things go. But obviously the risks, the downside risk is severe. You can step on a landmine and be killed out there. So yeah, that's the key, I think, is just for us to try and avoid those landmines. We are benchmark agnostic, so we don't feel we have to have a bit in every country. There's 20 countries that have issued Eurobonds. We are in 8 of them. I guess it's a balance between being fairly well diversified or having just everything for the sake of it. And we kind of are, we believe in some level of diversification for risk management purposes, but also we're happy not to own countries that we just don't like, or we feel it's too risky, or there's not enough yield, or it's something like that. And yeah, I guess a case in point is Ethiopia recently. If you go back even further than that, you'll see the bonds often very much move in lockstep. There's Ethiopia versus Kenya. You could have picked anyone for 2 years and wouldn't have made any difference. But we've had no Ethiopia. We've just felt that we don't quite buy their story of reform. We just think the yields were not high enough for the risk that we were taking effectively. That's it. So we've avoided Ethiopia, and it's proved to be pretty good case. Kenya's done pretty well since September, along with most of the countries. Ethiopia's had basically close on a civil war and some other issues with their debt there. So yeah, I guess key takeaway there is we firmly believe active management is key, just to try and avoid those accidents. Sorry, Mike.
So to summarize those points, and hopefully we've addressed them, we're obviously happy to address them in more detail with you, should you want to one-on-one. But we certainly feel you're getting paid substantially well for the risk taken. So additional 3.8% spread above the 2% that we've calculated one would need to invest in the space. Liquidity, over a third of what you're getting in SA markets, certainly hasn't been an issue for our fund, and it's growing. Certainly since we launched the fund, we were saying 300 to 500, we're now saying 500 in terms of daily liquidity. Local markets are not an issue in terms of investment for this fund. You are investing in Eurobonds, which are settled in Europe. You're not entering into those African markets, and you're not exposed to those local currencies. Volatility, as I illustrated, you do have a bit of volatility from the currency moves, and the underlying product itself is not, a very low risk product. You are getting compensated very well for investing in the space and getting a very high return. And as we all know, the higher your returns, the higher your potential risk. So there are drawdowns, but as Paul's spoken to, we are managing this in an active manner. We are trying to avoid the landmines that potentially exist in the space, and that has worked fairly well so far, touch wood. back in March, outperforming the market by 12%. And then on the global rising rates, as you can see, the spreads have come in when rates have started to rise in the US. So you aren't experiencing that negative attribution from rising rates as much as perhaps you would in other products. Right. Thanks for your feedback, by the way, on the questions. I'm just going to share the results. So we had quite a broad range of results from you, and hopefully we've addressed those all and quelled some of the fears or concerns that come with investing in this particular asset space. Right, so we're going to go into an example, and then we'll touch on the portfolio.
Sure, yeah, I guess we just wanted to give a little example of one of the countries that we've got one of the larger weightings in the fund. Just a reminder as well, this fund is predominantly sovereign Eurobonds, but the mandate does allow for up to 25% in corporate bonds across the continent, as well as local currency stuff. We see that really as just an option in case there's something really outstanding and exceptional. We'll only invest really in corporates and local currency on a very opportunistic basis. But Ghana is one of those right now where we've actually got a small weighting to their local currency, as well as a large weighting to their dollar bonds. Ghana is a country that has very high growth. You can see kind of over the last 5 years or so, you're averaging roughly 7%, 6 to 7% GDP growth. Even in 2020, which, as we know, obviously what's happened to global growth there, they managed to grow at 1% and should grow forward towards 5% in the coming couple of years. And that growth is important. A lot of the debt metrics that you look at for any country, it's all kind of debt to GDP, external debt to GDP, things like that. And when your GDP, when the denominator is growing so rapidly, it's actually very quickly that you get out of a negative debt situation, or alternatively, you can take on a lot more debt than a country that is not growing. So we're very comfortable with Ghana debt levels, and specifically because of the growth we're seeing there. Inflation Ghana's just always been a high inflation environment. Well, not always, the last decade or so. You could have just penciled in roughly 15, heading towards 20% inflation sometimes. There's been a big shift in the way the economy is managed, the way the government manages the fiscus over the last couple of years. And you can see inflation has come right down. We're now at 10%, and we, over the next year or two, should be getting to roughly 7 to 8% inflation, which is very, very good for Ghana. You're getting roughly 7% yield from the long bonds, the dollar bonds, sorry, not local, but dollar bonds. You're getting 7% yield in Ghana. And local currency, where we've got a small position, you're getting 18% yield for a 3-year bond, with inflation down towards, heading down towards 8%. And the currency, we think, is probably going to develop roughly only in the region of 6% a year from here. So a very, very solid real return from both your dollar bonds as well as your local currency stuff there. Sorry, might clicking on that, yeah. So yeah, I guess now's a good time to finish up and with the portfolio. You can see our weighting there to Ghana, it's just under 18%. Egypt is another country we like a lot. They are in the midst of a highly successful IMF reform program. So we're very, very confident Egypt, you're getting some good yields there in that country we like a lot. Just for what it's worth, in our equity fund, Egypt is also our highest weighting at about a third of the fund. You can also see there, I guess, we are very happy to be completely overweight and underweight countries. We very much just want to be where we think the risk and return matrix is attractive. We're very happy not to be in countries where we don't see any opportunities, and we completely happy being overweight countries we like a lot. So yeah, that's it from me. I'll hand over to Mike to conclude, and then we can get into some questions.
Thanks, Paul. Yeah, so hopefully that's alleviated some of the concerns around the region and given you a little bit of insights. Obviously, we could go through all of our portfolio and holdings and underlying positions on the curve that we hold across the countries. We don't have time for that today. Just in terms of why we think now is a great time to get into the product, we still think there's a bit of compression left in the spreads, and you can get brilliant returns out of the space, as well as your 6.8% dollar yield. As you saw, you're getting, and as I'm sure you're aware, you're getting close to nothing in sitting in international cash. So this certainly is a better option from that perspective. You know, you're backed by sovereigns in the space, and you are trading through the Euroclear or settling in the Euroclear market in Europe. Your assets are not actually entering into African space, so there is a bit of concern alleviation through that. Hopefully, you are investing potentially into the 10% bucket, which you perhaps have not been able to access otherwise. It's quite difficult to find an African equity fund in that space that is willing to limit themselves in terms of their universe to have a liquidity of a weekly or daily trader that then aligns as a unit trust, something we've not been willing to do with our equity portfolio. And we think that this is a great way of accessing that. And as you saw, we illustrated the low correlation diversification benefits of investing into this portfolio. And those who came in at the beginning of last year, we think have been well rewarded through last year. The fund did about 14.5% in rands. It's up about 10% in dollars. And we hope that it's still got some good legs from this point going forward. In terms of the fee deal capacity, it's something we've been running since inception. We're about to close it out at the end of this month, but if you come in the next week or so, you can come in at the institutional rate, which is a 30% discount on our A-class fees. And as we mentioned earlier, it's something we've invested in. We've had it in our multi-asset portfolios. So our clients have benefited from being invested in this, whether they've come in directly or they have been in through one of our other portfolios. Great. There have been a few questions that have come through. So I'll start with Leon's question. What is the total return you expect for this fund for the next 12 months if we assume that the rand dollar stays where it is?
Yeah, so that is a function of the yield you're receiving as well as any capital increase. Looking at the spreads, at how wide they are relative to high yield, we can very easily see this coming in 1% to 1.5%. The duration is roughly 6 years. So if there's a % move downwards in the yield, effectively you're going to get kind of 6 to 7% roughly there, plus your yield of close to 7%. So yeah, probably in the region of 14-ish%. Half from your capital appreciation and half from the yield.
Thanks. Then from Godfrey, he says, should we worry about debt sustainability in Africa?
Yeah, it's definitely always something you should worry about. But right now we're very happy with the debt levels of the countries that we own. Some are unsustainable and are going through tough times. Zambia is going through a default event at the moment. But this was pre-COVID. It was just complete financial mismanagement, taking on too much debt, very opaque situation there, and now they're defaulting. So it is something we pay very, very close attention to.
Then from Adam, do we have the volatility of the Eurobond index in dollar terms? Yes, Adam, we can get that to you. As we illustrated, certainly from our fund's experience, it probably has been quite a volatile period that we've been through last year, and we think it's actually been a great test of the product, and should.
But we're happy to send you the stats that the daily or monthly moves. If you can kind of use that data as you wish.
And then Joe has asked, what's the dollar yield on the fund? So that's 6.8 currently. The universe is just slightly below that, I think, at about 6.7.
Yeah.
So you are getting
that's your yield to maturity.
Yield to maturity. And then from Adam, what is the duration range of the fund? And do you aim for capital appreciation in terms of yield curve movements?
Yeah, so the duration is about 5.5, 6 at the moment, probably closer to 5.5. We would look to reduce that, I guess, if we thought we could time the markets or we were really worried about things. But right now, again, we're very happy with that. It's quite a good balance between, yes, that capital appreciation is very much a key part of the story here, as well as that yield. So if we bring that duration down to too large a degree, we just don't think it makes sense. You're just not getting paid enough.
Great. I don't know if there are any more questions to come through. I thought I'd add one more little poll quickly, just to see, give us sort of a gut feel of, it's launching still, of how you're feeling about the fund. We hope that we've been able to alleviate some of those concerns and address all of them. We have a fire alarm going off in our place, so maybe that's a good time to end. Otherwise, you won't be able to hear us. Thank you very much for your time today, and please do get in touch. Thanks so much. Ciao. Cheers.